Good morning, traders and investors. Roger Scott here, Senior Strategist for WealthPress. Today's Tuesday. It's March 28th. March is almost behind us. That means the first quarter is almost there. Now, it's about 7:42. The market's going to open up in a little bit less than 2 hours. The NASDAQ is down just a hair. The Dow is flat. This is very, 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 very random action. Now, there's a lot of things I need to talk about today. We've got a couple of reports coming out. We've got international trades in goods and services, and we've got consumer confidence. Now, pay attention to consumer confidence because it comes out about half an hour after the market opens. So that's going to be something really important and something we need to pay attention to because it's coming out ahead of the GDP. And that's really, really important, which is coming out on Thursday. Now, overall, and I'll talk a little bit more about this, but here's what you need to understand. And believe it or not, this may be one of the most important things I tell you this week. Look at the bond market and look at what happened to the bond market after the Fed data came out. This is when the Fed released their numbers and the banking crisis happened. Bonds went up, which means interest rates were subdued because there was a fear of a banking crisis. Well, as I'll go into my report a little bit later today, right now it seems like banks are gearing back up. Confidence is coming back, which means bonds are coming down. And we have a gap right here, as you can see right here. We have a gap down, and it looks like a descending triangle. You got to kind of just ignore this little thing here. To me, and to most professionals out there, or maybe not, I don't really care. I do my own analysis. It looks to me like the bond market's going to fill this gap. If the bond market fills this gap, and I'm kind of just trying to connect the dots for you guys, it's going to take a big bite out of technology and communication services. More importantly, look at the semiconductors. They look like they're starting to weaken up, and they're starting to look a lot like the bond market. Seasonally, semiconductors are very, very weak this week. Micron is reporting today, which I'll get into. Applied Materials is on the list. Intel, ADI. There's a lot of weakness seasonally in semiconductors. So we're going to have to watch the relationship between the bond market and semiconductors very, very carefully. And I think finally, we're going to start seeing some decline in these values coming down, which will make industrial consumer staples, material, healthcare the number one sector, not technology or communication services. But I'll get into that in a minute. As I mentioned again, GDP is the big report, which means tomorrow the market may be a little muted. But there's a big difference between tomorrow and today. So hopefully, we will get out of this in one piece. Now let's talk about global economy, and then I'll get into the nitty gritty. Because remember, today's Tuesday. Talk about the best sector, the weakest sector, the best stock, and the weakest stock. So rise in U.S. Treasury yield, which what I just mentioned, weighted on tech-heavy NASDAQ 100. More specifically, tech stocks, but I guess it roiled the QQQ. Let's see how the QQQ looks right now. Yeah, it looks like it's curling as well. There we go. It looks like it may come right back down here. So again, be very, very cautious with tech. I don't have any confidence in technology right now with where we stand. On Monday's session, First Citizen Bank bank shares surged over 53% after it agreed to acquire the loans and deposits of Silicon Valley Bank, fueled a recovery in financial stocks. Now, First Republic Bank also climbed 11% following a Bloomberg report that U.S. authorities were mulling an expansion of the emergency lending facility of the bank. Meanwhile, energy stock sector gained as crude oil rose over 5% on Kurdistan export halt and the banking optimism. Because remember, if banks go down, that means there's a higher chance of a recession. Energy doesn't do good in a recession. It does good in an inflationary environment. But again, tech-heavy NASDAQ 100 underperformed as jump in Treasury yield pressured rate-sensitive technology and growth stocks. And I'm telling you right now, the big vulnerability that I'm seeing right now is appears to be semiconductors. Again, don't shoot the messenger. Federal Reserve Jefferson said on Monday that U.S. central banks would try to avoid harming the U.S. economy any more than necessary. I think it may be a little too late for that. What do you think? Well, I'll let you guys figure it out. The current inflation rates are too high. It's the goal of the Federal Open Market Committee to get it back down to 2%. I remember that 2% number even back when Trump was president. In a way that is sooner as opposed to later. Well, good luck with that. It's going to be hard to do that without harming the economy more than you already have. But nobody listens to anything I say. Jefferson also noted that the stress among small banks could hit small businesses harder. I think that is not going to happen. I think most of small businesses have already moved to larger caps. If they mean liquidity, I don't think so. If they mean on a business level, well, that means that economy is only going to get worse. That's kind of what he's saying. So he's kind of talking from both sides of his mouth. Today, all eyes are focused on the consumer confidence data that's coming out in a couple of hours. Economists, on average, forecast that consumer confidence will stand at 101 compared to 102.9. Also, we're having, and this is a big one, U.S. trade balances, which was at 91 billion. They're now looking for it to be at 91, so it was just a hair lighter. Europe, the futures are up just a slight. Everything I'm seeing right now this morning is really random. Continuing positive momentum as confidence returns to the region's stock market after the recent turmoil in the global banking sector. China closed lower as a slew of weak earnings report from China's biggest companies, including China Petroleum and Chemical and China Hongqiao Group, I can't pronounce that, drummed up doubts over a quick economic rebound this year. China's not doing that well. They got a lot of post-COVID stuff to deal with. In addition, local media reports suggest the China export sector was running well below capacity amid weak domestic and overseas demand caused by worsening economic conditions worldwide. At the same time, the Nikkei stock closed slightly higher, led by gains in energy and financial stocks as concerns eased about the banking crisis. I'm telling you right now, that's going to cause rates to go up. Confidence in banks is going to cause interest rates, bonds to go down, which means interest rates go up. I'm telling you, I smell it. It's the sniff test. I could see it coming. PVH, we got some interesting earnings coming out today and some news. Lyft got a lift with pre-market trading after a board member selected a new CEO. You've got PVH, which is a pretty big company. It is up 12% pre-market after the company reported better than expected fourth quarter results. We've got some fun earnings today. Micron, it'll be very interesting to see how that impacts the semiconductor sector. Lululemon, one of my favorite pre-COVID stocks. Walgreens, not a great stock these days. Calmine, which is Calm, and Cureleaf. So keep an eye on that. Those are earnings coming out today. Some fun stocks, nothing really that crazy. Now, today is Sector Watch. Now, I'm telling you as I sit here right now, I wouldn't be doing my job if I told you to buy technology and communication services except chip stocks. I mean, especially chip stocks. Now, there's an exception to a few of these, but broadly speaking, I'm not a big fan of tech and communication services. There are some exceptions, and I'll go through them right now. As far as upside, I like industrial and I really like consumer staples. Consumer staples would probably be my number one choice right now because if we're going to see more inflation, that's going to be a problem. I also like material, healthcare, and energy. I like utilities. They're actually pretty strong this week. I think they're the strongest sector this week, which would make sense if interest rates start coming up. And financials are also starting to come up. I would be really, really careful right now with technology. I know it's counterintuitive, but I'm actually really bullish. I'm really bullish to safe stocks, and I'm starting to get bearish on the interest rate sensitive stocks. So all tech, be very, very careful with technology right now. I know we're long Apple in one of our programs, and it may take a hit, but Apple is more of a conglomerate. It's not really like very, very centric, and it's also part consumer discretionary, which I'm not as bearish as I am on tech and communication services. So Apple may get a reprieve, but technology stocks like chip stocks, ouch, not that happy about. Looking at stocks right now, the kind of stocks that I'm looking at right now, let me give you a few that I'm really liking right now. GE is looking fantastic. That's an industrial stock. Lamb Weston is making a comeback once again. That's a healthcare stock. See, like NVIDIA right now, NVIDIA actually wasn't on my list, but be careful with NVIDIA in the next couple of days. It may get hurt. Grainger, you want boring stocks. Quinta, utility stock, power stock, that's a great stock. So again, stay away from the speculative and tech for the next few days. It's probably not going to do you any good. Another one is Pulte Homes. So I don't want to get too specific about sectors. And I like Exxon. I think it's going to make a little comeback. Synopsys looks good. Now, again, in terms of bad stocks, right now, semiconductors, SMH. I'm telling you right now, SMH right now is due to come down to the 240 level, and I think it will over the next couple of weeks. I'm just not seeing a lot of love there. NASDAQ is already down, and it looks like it peaked out. Remember, with rates going down, this was it. This has to come back down because rates are coming back up. And probably it looks fairly overdone right now. I mean, momentum levels are not that high, but it looks like it could come off quite a bit. So my suggestion is to stay really light on semiconductors, tech stocks in general, QQQ type of stocks. Again, Apple, we'll see what happens with Apple. We're already long. Maybe we'll get not stopped out. Maybe we'll get out, maybe not. But I'm not as confident on technology as I was a few weeks back before this banking came out, because a lot of people put their money off financials and into technology, and I think it's going to undo itself over the next few days. Also, keep your eye on the bond market, TLT, for a drop to fill this gap to the downside. I'm seeing a lot of that happening in the next couple of days. Also, remember, tomorrow will be a muted session, so there's not going to be a lot of action in anticipation of the GDP. And when GDP comes out, you definitely want to pay attention to the bond market. Now, I could be wrong about all of this, but seasonally, we're not strong on bonds right now, and we're not strong on semiconductors, and that's giving me a pretty clear picture of what to expect. Now, other stocks that seasonally are not looking great is commodities. Commodities are not looking all that great right now. I know it rallied yesterday, but right now I'm getting corn, soybeans, agricultural stocks. They don't look all that great, and if interest rates go up, that'll put a damper on these stocks. Also, some bullishness right now is seen this week in the US dollar, which is kind of thumping along and not doing anything. So if the US dollar goes up, commodities will definitely cool off. And if semiconductors cool off, then we're definitely going to see some downside in chip stocks. Again, I just wanted to kind of give you the lay of the land. Now, folks, I believe I've cracked the code to the stock market. That's right. It involves one specific chart pattern and 146 little-known stocks. And the best part is it doesn't matter if we're in a bull or bear market. That's the best part of all. Now, I'm not using this pattern to just trade any old stocks. I'm using it on some of the most explosive tickers in the market. I think we just had a nice juicy gain yesterday of 40% on Dollar Tree. Now, I'm not using this pattern to trade any old stocks. As I said, very cool stocks that really are running away. They're not speculative biotechs, risky penny stocks, or crypto companies, but stocks that are on the move. And most of them may not even be in the S&P 500. Some may, but not all. So I'm really excited about this discovery that I just shared and how I trade the pattern and these companies. You don't want to miss out. Follow the link below. Watch this free presentation. You are going to absolutely love it. I promise you that. Now remember, post comments in the channel, like us, subscribe to the Wealth Press YouTube channel, post comments below the video, and there's a link to the Telegram channel where we give some free trades once in a while. And I post pictures of my pets. Follow the link. Get into it now. Don't miss out. And I'll talk to you later. Any comments, feedback, support at marketgeeks.com. I'll talk to you guys soon. Bye. Have a great day.